Hey there, and welcome to this explainer. Have you ever wondered how the pros actually pick winning stocks, while the rest of us feel like we're just, guessing? Well, today, we're going to distill the highly technical NISM Series XV study guide into a really clear visual journey of what it truly takes to be a registered research analyst. Whether you're an aspiring market expert gearing up for your certification, or honestly, just someone who wants to know exactly how the big players evaluate the stock market, you are absolutely in the right place. We're going to unpack the exact toolkit, the rigorous rules, and the economic frameworks these analysts use every single day to navigate billions of dollars in investments. Okay, so here's our roadmap for today. We'll be looking at the analyst's role, the economic big picture, fundamental and technical analysis, corporate actions, and finally, the regulatory frameworks that keep the whole system fair. Let's jump right in. All right, Section 1, the role of a research analyst. First up, we really need to establish why this demanding profession even exists in the financial world. So ask yourself, when regular folks want to invest in the stock market, how do they actually decide where to put their hard-earned money? Do they sit down after a long, exhausting day at work and read a 300-page annual report? Yeah, usually not. Honestly, reading corporate financial disclosures cover to cover is a pretty effective cure for insomnia. Proper research is just an incredibly time-consuming process that you literally cannot squeeze into a 15-minute lunch break. Think about the last time you bought a new smartphone. You probably spent days, right? Researching camera quality, processor speeds, different brands, battery life, all to make sure you got the best deal. Now, I want you to scale that up to investing your life savings in the stock market. Suddenly, you have to parse through complex micro and macroeconomics, dissect industry trends, and somehow evaluate management teams. Most investors just aren't in the market full-time, and that is exactly the gap SEBI-registered research analysts fill. They do the heavy lifting, synthesizing mountains of data, so you don't have to guess. Moving right along to Section 2, the economic big picture. Now that we know why they're hired, let's look at the broad economic landscape these analysts have to navigate. The really crucial point here is understanding the distinct difference between the two main economic lenses. On one side, we have microeconomics. This looks at small, individual units. Think of it like analyzing how a sudden interest rate hike affects one specific car dealership sales, or just a single customer's buying behavior. But on the flip side, we have macroeconomics. This is the big, aggregate picture, the total health of the entire economy. Here, analysts track massive variables, things like overall GDP, national inflation rates, and employment levels. It's essentially the difference between staring at a single tree versus surveying the entire forest. Because, you really can't accurately judge a single company without understanding the broader economic weather it's operating in. And speaking of that macroeconomic weather, calculating gross domestic product, or GDP, is absolutely essential. It reveals the overall performance and growth of a country. Analysts generally look at this through two methods that basically mirror each other. The income method calculates GDP by adding up all the money earned during a specific period by employees, professionals, entrepreneurs, and investors. Alternatively, the expenditure method calculates it by adding up all the money spent on consumption of goods and services across individuals, corporations, and the government. In a perfectly balanced economy, total income equals total expenditure. Tracking both gives analysts a vital pulse check on whether the entire economy is expanding or contracting. Which brings us to Section 3, Fundamental and Technical Analysis. Let's see how all this economic background builds into an analyst's actual toolkit. When evaluating a company for long-term viability, analysts dive deep into fundamental analysis. This isn't just basic math. It's a rigorous blend of quantitative data like scrutinizing price-to-earnings ratios, tracking free cash flow, and dissecting debt-to-equity metrics, combined with qualitative research. They aren't just staring at spreadsheets all day. They have to identify economic moats, define a company's competitive advantages, and evaluate whether a management team is actually capable of navigating threats. And today, this also heavily involves looking at ESG frameworks, environmental, social, and governance factors, to make sure the company is fundamentally resilient and sustainable from the inside out. But hey, the market isn't just about holding on to stocks forever. Analysts also have to monitor the distinct actions clients take. Trading involves buying or selling assets for short-term gains, leveraging quick market changes. Hedging, however, is basically your financial insurance policy. It's taking a position specifically to counteract potential losses from another position. Then you have arbitrage, which is like the ultimate scavenger hunt. Traders simultaneously buy and sell in different markets to lock in a risk-free profit from short-lived price discrepancies. And finally, pledging involves using existing securities as collateral to obtain a loan. A good analyst needs to know exactly which of these maneuvers their client is executing to offer the right advice. Now, technical analysis is where things get really visual. It converts all of that market history, price action, and volume into a language you can see. When you compare the structure of a standard bar chart to a candlestick chart, you'll see that both clearly display the opening price, the highest price for the day, the lowest price, and the closing price. But the candlestick uses a thicker body to instantly show you the battle between buyers and sellers, usually green for a price increase and red for a drop. By visualizing complex data this way, analysts can quickly identify price trends, market reversals, and specific buying or selling points in a way that raw numbers simply do not allow. Let's look at how this plays out in practice. Short-term investors absolutely rely on these technical signals, mostly because fundamental business models rarely change day to day, but prices, they fluctuate constantly. By studying these chart patterns, analysts look for support. Think of this as a floor where buyers step in because the stock looks cheap, which bounces the price back up. Conversely, resistance acts as a ceiling. It's a psychological price point where investors start cashing out, creating selling pressure that pushes the price back down. Recognizing these floors and ceilings is absolutely critical for timing the market. So when you really strip it all down, technical analysis relies on three non-negotiable pillars. First up, the history of past prices, which operates on the foundational assumption that market psychology and history tend to repeat themselves. Second, the volume of trading. The higher the volume, the more conviction there is behind a price movement. And third, time duration. In the markets, time truly is money, and holding an asset too long can completely erase your margins. These three elements are the absolute foundation of reading any price chart. All right, Section 4, Understanding Corporate Actions. Because companies are never static. They're always growing or pivoting. This brings us to a golden rule in the financial world. A public company has to protect the right of minority investors. This driving philosophy is the exact reason regulators and analysts scrutinize corporate actions so heavily. Everyday investors need someone in their corner to ensure they aren't getting the short end of the stick when a massive corporation makes a sudden, sweeping move. To protect those smaller investors, an analyst has to constantly evaluate the immediate impact of key corporate actions. This includes things like dividends or stock splits, which is where a company makes its individual shares cheaper to buy to increase liquidity, even though it doesn't actually change the underlying total value of the business. It gets significantly more complex when you bring in mergers and acquisitions, demergers, and share buybacks. An analyst's job is to instantly calculate how a sudden corporate shakeup will alter the value of their clients' portfolios and advise them on exactly how to react. And finally, Section 5, Regulatory Frameworks and Rules. Because all of this technical and fundamental analysis means absolutely nothing if the system itself isn't fair. This sequence right here basically builds the secret code of conduct for a research analyst. It's a strict chain of accountability. It starts at home with Regulation 15, establishing internal policies to prevent market manipulation. Then, to prevent front-running, Regulation 16 strictly limits an analyst's own personal trading around the time they publish a report. Regulation 19 forces them to air out any conflicts of interest. Regulation 20 demands the reports be purely factual, well-researched, and completely free of speculative hype. And finally, Regulation 25 acts as the ultimate audit trail, mandating the strict preservation of all these records. It all really boils down to one thing: preventing VIP treatment and maintaining total transparency. Regulation 22 prohibits the selective distribution of research reports, so no, you can't just text the best stock tips to your favorite high-paying clients first. Regulation 21 requires analysts to publicly disclose their financial interests when making recommendations on TV or social media. And Regulation 24 enforces a strict Chinese wall, an arm's-length relationship between research teams and investment banking operations to prevent insider bias. It is a highly regulated environment, all designed to maintain absolute trust. So, we've covered a lot of ground today. We've walked through the macroeconomic frameworks, the technical chart reading, the fundamental evaluations, corporate actions, and the rigorous compliance required by SEBI. It is an intense, detail-oriented profession where literal millions of dollars can hinge on a single, well-researched recommendation. After seeing the sheer depth of this toolkit, from tracking global GDP down to the psychology of a single red candlestick on a chart, you really have to ask yourself, do you have the discipline to master the research analyst toolkit? Think about it. Thanks for joining me on this explainer, and as always, keep learning.